Hi, and welcome to Symax Fintech Markley Insight. As usual, start with our disclaimer. So, trading involves the potential loss of risk of capital and is not suitable for everyone. As I always say, hopefully it is for you. Many companies provide leverage, so just be careful. You can lose substantially more than that initial investment. Everything that we include here is just purely for educational purposes. We are not trying to encourage you to trade or invest. That must be your decision. And before you make that decision, carefully consider the risks, your financial situation, levels of experience, and your risk appetite. And of course, only risk capital you're prepared, but more importantly, that you can afford to lose. If you have any doubts whatsoever, seek independent financial advice before you risk your capital. Okay, so when we look at last week, so earnings was a bit mixed. And then there was lots of data out in the US, and most of that data beat expectations. Durable goods was much higher than expected. It was up 5.6%. Okay, it was December, but I mean, the previous month to that was down 1.7%. And generally, when it comes to durable goods, they're the bigger ticket, so the more expensive goods, because they have to have a expected lifespan of at least 3 years. And then Michigan consumer sentiment came in again higher, 64.9. And GDP 2.9%, so even that was a beat, so that was good news. And then on Friday we saw PCE came out. It's the Fed's favourite inflation indicator. Core was up only 0.3% month on month, and it came in expected at 4.4% year on year. Moving on to Europe, so Lagarde has warned that the ECB is not finished raising rates yet. And even so, it was not a great week for the euro. It struggled to sort of make any further gains and break that 110 level. So it could be a make or break for it this week with all the central banks meeting. PMI came in back above 50, so again that indicates expansion in the EU. And although German PMI, the preliminary was lower than expected. Moving on to the UK, where I'm based, public sector borrowing jumped to 26.5 billion. PMI came in lower, as you would expect, at 48. Not much confidence here at the moment. But the PPI core was down, but still way too high. In Australia, manufacturing's dipping, and PPI was lower, yet CPI was higher. And this just emphasises to me that, if PPI is lower, those costs, those savings aren't being passed on to the consumer. And that's a concern, especially when it comes to food. And Bank of Canada raised rates by 25 basis points to 4.5, which probably indicates that they're going to take a little bit of a breather now, a little pause, just to see what's going to happen, as most central banks will do shortly, I would guess. So this is going to be an interesting week. We've got key data this week, so central banks meetings, and that should see more rate increases, plus Q4 earnings reports. And then just going into them individually, so in the US, obviously we're all looking forward to FOMC on Wednesday, expecting a 25 basis point increase then. And then, of course, the focus will be on the statement and the press conference afterwards for what expectations should be set for this year, and the pace of any more rate increases before they pause, just to see what happens with inflation. And then, of course, on Friday, we've got NFP to finish the week. And again, traders will be definitely focusing on that. When I look at NFP, I look more at earnings and hours work because they're inflationary data rather than just, I mean, they're at full employment anyway. And then also during the week, we've got Chicago PMI, some housing data and ISM. Then on Thursday, we've got the Bank of England, and we should expect another rate increase there. Although it's possible that Bailey may paint a slightly brighter picture for the UK economy. There are still dangers of that recession, but possibly not as deep or as long as he suggested towards the end of last year. We'll also see some housing data, consumer credit, and again PMI. Then moving on to the EU, Thursday, we've also got ECB with another rate rise on the cards. Could be 25, could be 50. Lagarde keeps warning and emphasising that they've got further to go. So it's just going to depend how aggressive they want to be. And then we will also have consumer confidence, GDP, PMI, CPI and PPI. So lots coming out from Europe. In Germany, we've got GDP, retail sales, unemployment, and also CPI. So it's going to be an interesting week. Lots coming out. You're going to see lots of market moves for sure. And then it's going to depend on that data, how things will move forward this year. New year, new start, new central bank meetings, new policy. I don't think so. Okay, so then when we look at the macro, although inflation's moving in the right direction, it's just still taking too long. And as just mentioned, I feel some of that is down to companies, especially in the food sector, taking advantage of us, the consumers. So in the US, the PCE, the Fed's preferred inflation indicator, the core came in up 0.3, which is not bad. I mean, obviously they'd like to have seen it go down. And it came in line at 4.4%. But that is still more than double the Fed's target. Remember, 2% is their target. And as I keep mentioning, do not expect a quick reverse of policy from the Fed, as they will need to see inflation if and when it gets back to that 2%, I reckon for at least 3, possibly 6 months. And that's before they even consider any change of policy. Inflation has scared all the central banks for sure. And of course, it's been a struggle for them because most of it's been on the supply side. They can dampen demand, which is obviously what they've done. But even that has been a slight challenge for them just because of the amount of stimulus that was done in quantitative easing by the governments and the central banks in the first place. They have caused some of this inflation themselves. And then, we've got to be realistic. When we get these very low rates, it's because central banks, we're in a crisis, the economy is in a crisis, and therefore central banks will use reducing interest rates as one of their tools. But, we shouldn't simply expect them to return to low rates just because inflation drops. I really don't see it. And of course, now another issue is that China's reopening. And, with that reopening, we could see yet another wave of demand coming in. They've just had Lunar New Year as well. You've got frustrated consumers released and a potential shortage of workers because COVID must be at record levels despite the fact they're not admitting it anymore, especially after last week with hundreds of millions travelling around the country and outside of China to see friends and family. And again, if that causes a lot of self-isolation, that's going to reduce the amount of workers that are available, which in turn means that there's going to be shortage of workers to make the products. You know, I heard that some factories or some companies, you know, they're trying to get their staff to sleep in wherever they're working on the premises, so that it reduces that risk of contamination. So stagflation is still a risk for some countries, although there is the potential for other countries to miss recession possibly, or at least for it to be shallow and shorter. You know, that's obviously what was previously expected, and of course, let's hope so. Now, these supply chains, as I mentioned, you know, they've improved. Of course, they have, and costs have returned to sort of pre-COVID and pre-war levels. But you know, I'm just a little bit concerned with China whether they will have enough staff to produce the goods. Mentioning the war, so you know, the war's coming up to 1 year. Amazing, isn't it? And you know, 1 year when Russia first invaded, most people just thought it was going to be over in a week or so. I mean, well, you know, well done, Ukraine. Now, however, it does seem that Russia's going to prepare for a new offence, ground attacks in spring. So, you know, they've been sending over hundreds of missiles on a regular basis to try and break the resolve of the Ukrainians, targeting really, you know, their resources such as water and energy. Now, in Europe, with that warmer than usual winter so far, you know, it's a relief must be a relief for the governments and, of course, the central banks as well, you know, the ECB and the Bank of England, because energy prices stabilised. Again, for me, I've just got to highlight this. Food prices still just seem way too high for me, and they still seem to be going up as well. And you know, I just don't know whether that is really the suppliers taking advantage and or the supermarkets. But you know, for me, they really are taking advantage of us, the consumers, by putting those prices up and keeping them there when, you know, it's difficult to sort of justify that. Okay, maybe they got to pay a little bit higher in cost for energy and for wages, but nowhere near where it was before. And then, of course, employment remains high, and that's despite the banks and the tech layoffs. And of course, that's going to keep wages higher for longer, although they're not going up at the same rate that they were. But it has led to a lot of continued strikes in the UK as well.